When we first started working on our advisor succession study in the full-service brokerage channel, the concerns surrounding aging financial advisors were primarily focused on a few key issues. First, we're facing a demographic shift. The baby boomer generation, which is the largest demographic group, will all reach retirement age by 2030. And many of the advisors who have been servicing those clients for decades are part of that same cohort. So there's a growing concern that we could see a large number of experienced advisors leaving the workforce at roughly the same time. This creates the potential for what we refer to as an advice gap, essentially a shortage of qualified advisors available to support investors. This concern is amplified by the fact that for more than 20 years, the number of advisors in the brokerage channel has barely grown. We haven't really seen an inflow of new, younger professionals that would be needed to replace those who are eventually going to retire. We only need to look at other countries to see how real this risk can be. In the UK and Australia, for example, regulatory changes triggered a sudden exodus of advisors. Australia lost more than 40% of its advisors between 2019 and 2022, and the impact was immediate, especially for mass market clients with smaller portfolios, who suddenly had far fewer options for accessing advice. Those examples have become a cautionary tale for Canada, reinforcing why succession planning and advisor recruitment need to stay top of mind. Within the existing advisor population we track, we have noticed that the age distribution has shifted. Over the past 15 years, older advisors have become the fastest growing cohort. And while many continue to run large, successful books well past the age of 65, the question for firms remains in how productive these advisors are relative to their younger peers. Overall, the concerns around aging advisors fall into three main buckets. First, the impact of a potential wave of retirements from a large demographic cohort. Second, a limited pipeline of new advisors entering the channel. And third, the risk that productivity declines over time, with those advisors who continue to work past traditional retirement age. Taken together, these concerns highlight why firms are heavily focused on succession planning, advisor development, and programs designed to bring the next generation advisors into the industry. The advisor landscape today is shaped by a few very clear trends that signal both stability for now, but emerging challenges for the industry. First, we have a highly tenured advisor base. We're actually seeing the highest level of advisor tenure we've ever recorded. Currently, about 40% of advisors in the brokerage channel have more than 20 years of experience. This tells us that we have a large, seasoned cohort that's been in the business for a long time. But it also suggests something else. We're not seeing a strong pipeline of new, younger advisors entering the channel. So the experience level is rising, but the rejuvenation rate is not. Second, the average age trends are shifting slowly. When we look at the average advisor age, the increases since 2015 have actually been fairly modest, which suggests that while some younger talent is entering the industry, it's just not at the rate that would dramatically shift the averages. And third, we have stagnant advisor population growth. For nearly 20 years, the full-service brokerage channel has hovered around roughly 10,000 advisors without meaningful growth. Within that static total, however, the composition has shifted. And within the banks, we have seen a decline in advisor headcount over the past 10 years, while at the same time, independent firms have grown by more than 20%, driven largely by aggressive recruitment. And so while the workforce isn't growing, it is reshuffling. Finally, older advisors control the majority of assets. When we look at advisors over 55 and older, these make up nearly 40% of all advisors and close to 50% of total assets. In other words, half the assets in the Canadian brokerage channel are managed by advisors who are nearing or past traditional retirement age. So overall, today's advisor landscape is experienced, stable, but aging, and not being replenished quickly enough. This combination raises important questions about the future capacity in the channel, but not necessarily today, but certainly over the next decade. Well, at first glance, the numbers might make it seem like an advice gap is inevitable. But interestingly, that's not the view of most dealers we spoke with. Despite the aging advisor populations, firms feel they have the situation well under control, and they're not expecting a sudden shortage of advisors. One of the biggest reasons for this confidence is that advisors are continuing to work well into their 60s and 70s. During our study, we repeatedly heard comments like, "We have an aging population of advisors, and we're not seeing them retire." For those advisors who are already over 65, many are not stepping away. They're still actively managing and even growing their businesses. Many have large teams in place who support the book when they're away, which helps smooth continuity. And these dealers aren't necessarily pressuring these older advisors to retire. Instead, the focus is on ongoing conversations about identifying a future successor and planning well ahead. The priority is planning, not replacing. Ensuring that advisors who may be nearing retirement are thinking about who will eventually take over managing their clients. While having advisors work longer does help delay any advice gap, it's not always ideal for long-term growth. Some of the senior advisors manage extremely large books, and they represent a substantial portion of channel revenue, meaning they can be challenging to influence, especially if new asset growth begins to level off. Firms recognize that sustained growth typically comes from advisors who are still aggressively building their practices, and that's harder to maintain deep in retirement years. So in the near term, most firms say there is no risk in advice gap, but in the long term, the industry can't ignore succession planning. As more advisors eventually choose to step back, the challenge won't just be having enough advisors, it will be ensuring those successors are prepared, motivated, and able to retain the clients they inherit. When we spoke to firms about how they're managing an aging advisor population, the consistent theme we heard was that the industry has really doubled down on structured succession planning. That's become the cornerstone of how they're addressing this challenge. Most firms have put formal succession plans in place to make the transition from a retiring advisor to a successor as smooth as possible. So as their advisors approach retirement, the firm will involve branch managers and/or their practice management teams early on to make sure both the outgoing advisor and the successor are fully prepared for the transition. These conversations typically start well before the advisor actually retires, sometimes years in advance, so the handoff doesn't come as a surprise to clients or the firm. One of the most important decisions in the process is choosing the successor. Firms do give advisors the freedom to select who they believe is the right fit for their clients, someone who shares similar values, philosophy, and an approach to managing the book. But firms don't necessarily take a hands-off approach. They still verify that the successor is in good legal and compliance standing, the business philosophy aligns with the firm, and they're prepared to grow the practice, not just maintain it. And even though firms may use slightly different succession models, the goal is always the same: provide a clear, structured path for transition. A big part of managing aging advisors isn't just the mechanics, it's also preparing the advisor personally. Firms will try to work closely with them to make sure they're emotionally and financially ready and that the practice is structured well enough to be passed on. Branch and regional managers play a huge role here, coaching advisors through the steps and encouraging early planning. Even if advisors aren't ready to retire today, many have signaled their intention to do so in the coming years. Firms see this as an opportunity to build continuity well in advance, which helps prevent client disruption. Clients understandably also worry about their advisor's retirement and who will take over looking after their assets. So firms aim to identify successors long before the actual retirement date, most preferring a 3 to 5 year transition window, which gives the successor time to build relationships, learn the book, and ensure a smooth handoff. It is also important to acknowledge that not every succession does go as planned. We've heard stories from advisors who tried to buy a retiring advisor's book only to encounter delays, unclear expectations, or shifting timelines as the retiring advisor made changes along the way. Succession is both financial and emotional. It doesn't always happen on a straight path. Valuing the book of business is a critical piece of this puzzle. Most firms provide a valuation range, but will leave it up to the final value to the retiring advisor, which gives them control over their own exit. Early successor identification is key. Without a plan, there's a real risk of client disruption and assets in motion. By getting ahead of the transition, firms protect client relationships and create a more predictable retirement path for the advisor. It's not always a seamless process, but the framework is there to help manage it. When we look who's actually buying books of business today and how advisors can best prepare, two themes really stand out: the growing importance of teaming and the need to identify the right next-generation successors well before retirement. Teaming has become a cornerstone of how firms manage succession. It's no longer just about giving advisors backup support. Teams now allow practices to scale, to service increasingly complex client needs, and to ensure clients experience continuity through a transition. Teams can help advisors handle much larger books and enable specialists to support different parts of the client experiencing. Most importantly, teaming provides a built-in pool of potential successors, people who already understand the clients, the systems, and the practice's philosophy. But from a firm's perspective, they do worry about the next generation of asset gatherers and ensuring the successors coming up the ranks have the drive or the entrepreneurial mindset required to be an effective asset gatherer. Firms are trying to develop associates and junior advisors, but they're also very aware that not everyone wants to be a lead advisor. Not everyone has the personality required to grow a business. So identifying the right successor early is critical. The good news for retiring advisors is that demand is incredibly strong. There's no shortage of buyers. Most firms say they have advisors lined up waiting for opportunities. When it comes to who's buying these practices, most happen internally, which means the vast majority of transitions stay within the same firm, often within the same branch or even within the same team. The biggest takeaway for advisors for succession is to start early. When we step back and look at the full picture, the story of an aging advisor population is definitely complex. But most dealers we spoke to told us they feel quite confident in how they're managing it today. The issue is real, but the immediate risks are low. Our analysis shows a clear trend. The advisor population is aging, and more advisors over 65 are continuing to run their practices. But despite that, firms do not seem concerned about an abrupt drop-off in advisor supply or an immediate advice gap. And this isn't just a Canadian phenomenon. The US is experiencing the same thing, with the over 65 segment being the only growing advisor group in the past 5 years. So the demographic pressure is absolutely there, but the industry isn't panicking. Interestingly, while firms feel comfortable, advisors do tell a slightly different story. Approximately 35% of advisors over 55 say they are concerned or extremely concerned about transitioning their business. And that makes sense because the responsibility of managing the transition typically lands on the advisor and not the dealer. Advisor succession has become a core focus for almost every major dealer. Firms know that smooth transitions reduce the risk of money in motion, which is ultimately what everyone wants to avoid. We are seeing the rise of even specialized succession support firms, which focus on valuations, exit readiness, and transition management. And this support will only get more visible as the trend accelerates. And based on the data, succession pressure isn't a short-term issue. It's something we expect to play out over the next decade and beyond. The bigger long-term risk may not actually be an advice gap, but retention. While the industry may avoid a near-term advice gap, the larger challenges ahead are likely not just advisor retention, but client retention. Succeeding advisors aren't just acquiring a book, they're paying for the future revenue streams of current clients, their spouses, and eventually their children. So firms are focused on building tools and programs aimed at helping new advisors retain these relationships, particularly the growing population of female investors and younger, more digitally native clients. As we look ahead, technology will be one of the biggest forces shaping the advisor landscape. AI, automation, and digital portfolio tools are already helping advisors manage larger books more efficiently. And as books get bigger, teaming will play an even more critical role, allowing practices to scale and support wider client bases. But even with all the preparation, transitions aren't always smooth. Retirement can be emotional, plans can change, clients' preferences can evolve, and regulatory shifts or technology disruptions can complicate even the best-laid transition plans. As we look ahead, the story becomes much bigger than advisor retirement. We're entering a period where massive intergenerational wealth transfer will reshape the industry. This means the issue is shifting from advisor succession to client succession, supporting the inheritors, the next-gen investors, and the changing expectations that come with them. So the real long-term challenge won't be simply transitioning books. It will be growing and retaining those books over multiple generations.